Very good day all. Thank you for attending this session, aptly titled "Should Risk Map Funds Surprise Clients?" So sort of sticking on that theme and sort of not only what's happened this year, but really in regards to sort of risk profiling. Today I'm going to be touching on a few things here, sort of looking at underlying growth funds, sort of giving an example of different ways funds have been able to sort of achieve or not achieve their risk profile. But really, I wanted to focus on this sort of description here, or little cut from the FCA finalized guidance to assessing suitability that was released all the way back in 2012. But there is a little section there where it goes, where a firm creates or uses risk-rated portfolios as part of its SIP, it must ensure the portfolios align accurately with the risk descriptions and outputs from any risk profiling tool it employs. Now, I've just sort of stuck it there just to sort of keep it in your heads, sort of moving forward. But sort of kicking it off, I wanted to start with the whole idea of whether or not people like surprises. Now, it turns out there's a full science behind surprises. And it's quite an interesting sort of read, because they always go, surprises are things obviously unexpected or just something you never sort of saw coming. And the more you expect something, the less of a surprise it is. But it turns out sort of everyone goes through the same sort of stages when it comes to surprises. And it always sort of kicks off with a sort of shock factor at the beginning. And when people are surprised, you freeze for 1/25th of a second. But in that moment, you take everything in and you sort of assess as to, what's happened, why has this happened? And surprises, they tend to say, are good for you, whether good or bad, but you tend to have sort of obviously different overriding reactions. And you can have a surprise. If it's good, then your sort of body's filled with euphoria, you're happy for it, and it can actively sort of change the relationship you have if it's the person that has surprised you. To the flip side, surprises on the bad side, again, people do tend to like shocks, but it can build up the sort of negativity that people tend to have. And the emotions that come with surprises tend to be fourfold compared to any other type of emotion you tend to have outside of a shock. Now, the reason I'm sort of asking this is because, when it comes to investing, should people sort of be surprised? And you always tend to see with all the tools that you have in place when sort of risk profiling a client and sort of giving them their expected outcomes, the whole idea is to sort of reduce this level of surprise that they have. And this is why you tend to sort of see this chart, that chart you tend to give clients where it gives you your chance of, the orange being the average return you should expect over the course of your investment, that sort of gray dotted line being the 5% chance of obtaining return sort of here and above. And then that blue line where it's, you've got a 95% chance of returning at least here or anything higher. Now, the sort of surprise comes when you end up with a fund sort of performing below that blue line. And, it's sort of well known in the industry that clients tend to never be surprised when they're achieving a lot more than what they should be getting, but always tend to be surprised when they're achieving even just slightly less of what they should do. And that's really that sort of negative surprise factor there. So this is why the likes of, Defacto, other sort of risk profiling tools, and even sort of asset managers sort of produce funds to always sort of design to stay in line with those expectations, to just try and remove that surprise as much as possible. And you can see when looking at the average returns of Defacto 4-rated funds, they tend to always sort of sit within this banding. And you can see the top performing funds have sort of sat just above that sort of grey line, happy days for some. The majority, the average, sits quite nicely within that average line. And those that have underperformed, even though there was a little blip at the beginning, have still shown that over time, they can give you that positive return, or at least sort of sitting above where clients should expect to see returns. Now, although it looks good over the long run, if you do end up having a little blip at any one point, which sort of forces it lower to what clients have, that is a surprise. And, even though you can say in hindsight, we've performed better over the long run and stayed within your long-term expectations, hindsight tends to not mean as much to clients when it's happening in the moment. As I said, that emotion sort of comes up 400% of what you tend to expect it to do, and that's when they really start asking questions as to why this happened. But is that really a bad thing, sort of seeing blips in returns in the markets, and even if it does sort of surprise clients. And really sort of down to what you're really investing into and the reasons behind it. Now, I wanted to give an example because, we have seen this year, a big surprise, not only to investments overall, but to the greater economy and to pretty much every single person throughout the world. And I wanted to sort of take a look, just sort of backward looking, as to see where sort of companies were positioned before the shock, to really see were they sort of doing it in regards to their underlying views or within the client's level of risk. Now, sort of kick it off, when you think back, just before 2020, the end of 2019, we'd pretty much been in a bull run for the last decade. It's been one of the longest runs we've ever seen. And we were sort of knowing we were coming towards the very end of the market cycle. We were at that very mature stage when you've seen pretty much year-on-year growth for most of the last 10 years. We knew that it would be coming towards an end. However, you can never really judge how long that tail goes for. You can be at the mature end for 6 months, you can be for 6 years. But the majority of the market still gave 2020 as a positive year moving forward. And there were good reasons when looking at the underlying. If you first sort of focus on the likes of the UK economy, up until the end of 2019, a lot had been priced into the market because of things such as Brexit that was going through. There was a lot of uncertainty of what would happen to the UK. But the underlying statistics were very, very positive. When you think of the UK economy as a whole, we've seen employment rates at the highest level we've seen in decades, meaning that unemployment number was at the lowest. You had overall growth of the economy hitting higher and higher each year. But it wasn't priced into the investment side. However, by the time 2019 came to a close, we had a majority government in place. Whether you wanted them or not, that was good for the overall economy because it started to remove that high level of uncertainty. We were now able to sort of push things forward. And you saw that with the likes of the exchange rates, against the dollar, against the euro. We've been hitting lows over the last 3 years. But the last quarter of 2019, especially when that majority government came through, you saw this rise against both currencies, and it was a positive sign for the UK moving forward. So it really meant, as an investor, the UK was value. Extremely low price, the underlying was looking good. The only potential way for growth was up in a bull market moving forward. And sort of on the flip side, outside of equities in the UK, when you're looking at things such as bonds, and especially government bonds, by the end of 2019, they were expensive. I mean, expensive to the point of asking yourself, should I be invested into them for growth? And again, if you look back at some of the major sort of government bonds available, in 2010, you were getting anywhere between just under 3.5% to over 4% yield. Now, 10 years down the line, we've seen those yields shrink drastically. I mean, the reduction in there has been extensively large. So investing, I say today, at the start of 2020, the question was, is there still potential within there? Now, a couple of them there are giving you positive nominal returns, but take into account inflation, and they are all giving you real negative returns. So for someone looking for growth, government bonds were probably not the place to be into. Forget diversification for a second, because government bonds have shown to be good diversifiers historically. But for growth purposes, you weren't looking at potentially getting anything given the current value. So it was now the push. If you're in fixed income, look elsewhere. Either look towards, corporate investment grade, or to what more and more people were doing, looking towards high yield as an alternative. And there's a good reason why. When you look back at high yield, even over the last 5 years, the Sharpe ratio, or the risk return, was the best for high yield 4 out of the last 5 years. And when markets are in a bull run, you are potentially getting greater growth for just taking on not so much more risk. So for the end of 2019, beginning of 2020, the outlook was relatively okay for the market. Brexit was still potentially still uncertain, but a lot of that uncertainty had been removed. From a global perspective, yes, you had the US-China trade war. it was easing, but there was still a level of uncertainty there. And given the sort of big push for the US, the question being, will it continue to have its growth, or will you be looking elsewhere for equities? And that's really where you saw those that were looking for growth and positioning themselves towards the end of 2019. There was a bigger focus on UK equities. There was less of a focus on government bonds and more towards high yield. So if we sort of focus on these four key areas, UK equities, US equity, high yield bonds, government bonds, and sort of position as to where these funds are invested for the start of this year. Now, within Defaqto, they do give their technical characteristics for each of their risk profiles, and they sort of stipulate the asset allocation for each level you're looking at. So sort of focusing on the risk profile 4. They state for each one of these, first and foremost, with UK equities and US equities, they give you a defined number. And they say within the asset allocation, you should have 10% in UK equities and about 20% in the US. Now, they don't break down into global high yield and global government bonds, but just looking at the average, it sort of sits about 9% for high yield and about 15% for government bonds on a global basis. Now, there is a tolerance level for each asset class, and if your fund sort of sits within any of those tolerances, then it should be matching your overall risk profile 4. Now, if we looked at the average holdings within the 20 to 60 sector, so it's the same sector, but not necessarily a risk profile 4, you can see that there was a lot more funds holding more UK equities. There was a lot more funds holding less US equities. Same with likes of high yield and with government bonds, either holding more or less than what you should be. Now, that's just within the sector alone. But even if we focused on other risk profile 4 funds that are rated by Defaqto, the figures are not that much different overall. In some cases, the likes of the US, they were holding a lot less than what should have been, but relatively similar. And as we know, there was a big surprise in 2020, and all of those sort of focuses for growth didn't really happen the way people expected it to. And when you look at the sort of 10 worst performing funds within that risk profile 4, you can see that their asset allocation was very different to what a risk profile 4 client should be. UK, they were holding twice the amount. US, they were holding less than half. Now, don't get me wrong. If COVID-19 didn't happen, these will probably be the best performing funds within there. So it is really the question of, is it a bad thing? Just because you're not matching the asset allocation, yes, you could have that blip where it could fall more than what was expected because you're not following that asset allocation. But for clients, is that a bad thing? And first and foremost, I focused on the asset allocation within there, but that's not the be-all or end-all of risk profiling each type of fund. There is volatility to sort of consider. And all the sort of risk profiles in Defaqto have always sort of stayed within their boundary to an extent. More importantly, they're not interacting with each other and overflowing one to the other. You're still getting a very defined range. So for those looking for long-term growth, yes, there's a blip in one part, and yes, it may give a surprise to the client, but historically, these funds have still been able to show they sort of give you a set sort of level based on that overall risk profile. The sort of question could come along if you are looking specifically for income or drawdown and you're not taking a natural yield. So if you're having to sort of cancel off units to be able to supply that for clients, in which case, yes, it is one to take into account those blips more often than not. And a good way is sort of looking at drawdown. If we go the highest, the average, and the sort of lowest returning, at the highest point, the drawdown was a lot lower. So happy days. If you're having to cancel off units, you're not going to see much of a blip on the downside. The average, yes, a little bit higher. It's where you get to the sort of the underperforming, whether or not they were just good or bad funds, or if they were overly exposed to one area or the other compared to your risk profile. We're seeing continual falls of 10, 20, 30, 40, 50% within there can affect sustainability when having to cancel off units. Because you're having to cancel off units when funds have fallen 50% in value, you're in essence having to sell off twice as many as what you would have done. So just really sort of one to take into account. But really the question is, what are clients looking for when it comes to investments, and what are you looking for to sort of match your clients' needs? And you can really break it down into two pots. You can have the reason to invest being the fund manager, or reason to invest being the risk profile. Now, they are two distinct beasts. I mean, if you're buying the fund manager, in essence, you're buying the firm. You're buying it because they're doing something that really makes them stand out or fit what the client needs. Now, that does mean that they would tend to run by their own mandate or by a different sort of modeling tool, not necessarily assigned with your risk profile. It does offer potentially the higher returns or speciality types of investments. But one thing to note is that the assigned risk profile could potentially change, and it might not match the risk profiling tool you're looking at. In comparison, if you're buying the risk profile, you're not necessarily buying the firm, but in fact, you're buying the process, the underlying as to what they're doing. Because if you're focusing on the risk profile, you do want something that is run to a specific asset allocation or volatility banding or targeted level of risk within there, with the focus of staying aligned to that risk profile. Now, for advisors and for clients, it sort of eliminates most of that work to keep on reviewing. Does that fund still match what my client is looking for? Is it still doing what I should think it's doing? Is it going to give me any further surprise? But with that, you do potentially sacrifice larger gains. The example I gave earlier, for those funds that were focusing fully on the risk profile, again, whether it be volatility banding or asset allocation, they probably wouldn't have been taking such large bets one way or the other for growth. Now, again, if you're looking for that growth aspect, if you're looking to be able to sort of deviate away from that level of risk, then buying the firm does work very well. But again, that's not the only reason. When you think of buying the firm, it could be for that extra growth. It could be because you're looking for something like ESG. If it doesn't fit the risk profile you're looking for or the specific needs of the client, you do have to look outside of the level of risk. To the same point, if you're looking for income, as an example, we saw sort of dividend cuts pretty much across the board this year. We've seen at least 35 firms so far with the potential even higher, having to cancel, suspend, or reduce their dividends in the UK alone. We've seen a potential 18 billion lost by the end of this year. But for those funds that are focusing on income, yes, there is a loss. That just simply means that you potentially have to take greater risk to be able to supply that yield. Now, for those needing an actual income fund that is focusing on that yield, then matching the process or matching that risk profile just probably wouldn't fit. You'd end up having to take a lower yield overall. So there are distinct reasons of buying the firm, for one reason or the other, to suit your client's needs. To the same point, if you're buying the process, what you're really in essence looking for is something that matches. If you're looking for a range of funds that stay aligned to that risk profile or matches what the client's outcomes are, that's what buying the process is. And then really it's the case of how rigorous are the underlying process. Will it always aim to stay aligned? Does it match your risk profiling tool, or does it run its own independent one? And how different are they? But they do fit as that sleep easy, less of a surprise type investment. And all of that sort of brings me right back to the sort of start where I gave you that sort of cut or excerpt from the FCA finalized guidance. And I'll put it back on the screen now. And sort of everything I've sort of run through, especially in regards to risk profiling, you can see this is what the FCA are focusing on in regards to that. If you are basing your client's investment on that risk profile, if it's part of your investment proposition or your retirement proposition, it must ensure that that portfolio lines accurately. And it's down to the advisory firm to make sure that it stays aligned. Now, the one thing I sort of missed out from the beginning is that the FCA do put in a slight warning towards the end. And I'll highlight it now. They do state it is the responsibility of the firm to ensure this alignment. And where there is a misalignment, there is a risk of systemic mis-selling. And what the FCA is pretty much saying is that if you did say you're going to invest a client based on their risk profile, and again, whether or not it's a transactional client or a client that you see on a regular basis, you have to make sure that that investment is always going to match that client's level of risk. And if it doesn't, then you're liable. And you can sort of see that with the likes of the Financial Ombudsman Service. They've produced case studies in the past which do focus on this. The whole idea of actually, does the investment match what the client was told they'd be getting, based on your level of risk and what you're happy to sort of lose and potentially gain on top. And in all of their case study, there's sort of always one in favor of the client. There was even a live case this year where, again, they voted in favor for the client that they had been missold. And so much so, there was an actual update to the finalized guidance from the FCA, which was sort of completed a couple of years back now. But again, just to sort of give you an excerpt of that, they did highlight that their review tended to identify issues in two key areas. Now, there's only one that I wanted to focus on. It was the first one within there. But they do highlight risk profiling. And they say that where firms are not considering or mitigating the limitations of the risk profiling tool they use, or where recommended solutions did not match the risk of the customer was willing or able to take. Now, the key part there is sort of highlighting the mitigating limitations of risk profiling tool, because what they're saying is that it's not down to your risk profiling tool. If it doesn't match what the client is looking for, it's not de facto's result, it's not anyone else's fault, it's the requirement of the advisor firm to make sure that it will constantly match within there. So again, the whole sort of point for this is that if within your investment proposition, within your retirement proposition, you are focusing on investing the client based on their risk profile, the key is sort of having that rigorous part in place to sort of highlight, are you buying the firm? Are you buying the process? And how are you keeping it aligned to that? If you can highlight that, you're pretty much ticking all the boxes that they need. And that's really down to it. It is fitting in with your needs. More importantly, it's fitting in with the client's overall needs. And if you can position a range of investments or a set type of fund that covers them, funds at the end of the day are just tools that you can use. Even with sort of risk profiling, you can decide to buy sustainability, buy income, buying the firm itself, or buying specific risk profiles. You can even sort of amalgamate them together. If you are actively using risk profiling to invest your clients, you can always use the likes of de facto's risk map as the core basis of that investment and utilize different types of buying the firm or buying that fund manager as more satellite approaches, knowing that the core will be aligned to the client's risk profile. And for those looking for that more sort of sleep easy solution for clients that knows it's going to match, buying the funds that solely stay aligned to those risk profiles could also match what you're looking for. But it is the case of not just having one or the other. And that's really the sort of end result with today, is that everyone is sort of different with the way that they invest. And gone are the days now of just looking at it as one or the other. I'm only going to buy one, I'm only going to buy this, or I'm only going to buy that. The technology is there, and it is a lot easier to use than what it would have been 15, 20 years ago. The options now, don't just buy one, don't just buy the other, but being able to blend different styles, different strategies together to help with clients. And it's especially true for those sort of looking at income, to be able to turn around and say, I don't just have one strategy within my retirement piece, but I've got different styles to utilize the best of both worlds for clients. Now, hopefully, I've sort of run through most of those sort of learning outcomes today. As I said, surprises in life are always a good thing. We do try to sort of limit it on the downside or the negative side, especially for investments, because we know that over the long run, they should always end up matching. Hindsight is always a good thing, but being able to sort of keep it aligned to what the client is looking for helps with that sort of sleep easy approach, and be able to just know it will always fit with the client. Now, that's everything I sort of wanted to talk through today. I will sort of end it just with a very brief overview of one of our ranges that you can find within de facto, and that is our CanLife portfolio funds. Now, as a very brief overview, these funds are, in essence, they're 5 globally diversified fund of funds with a focus to stay aligned to the client's risk level. They're meant to give that client an expected level of return based on their risk, both on the upside and the downside, but clearly staying within that defined level to sort of mitigate or reduce the level of surprise a client would see throughout their retirement journey. Now, to do this, we do sort of diversify across, dare I say, more traditional asset classes. We use fixed income, we use equities, properties, cash. We do have access to other types of asset classes, alternatives, and everything else. We do find that for that more sleep easy, staying aligned to your risk profile, the more traditional asset classes not only offer better liquidity, but more ease of use, more simplicity with the underlying. Now, when it comes to our asset allocation, we do review this on a daily basis. And 9 times out of 10, we will rebalance on a daily basis to keep that aligned to our asset allocation. And that in turn sort of keeps you aligned to your risk profile. Now, it's not automated. We do review daily and decide whether or not rebalancing would be beneficial or worse for the client for their level of risk and their level of return. Now, to do this, we do mainly invest in in-house funds. They're not purely fettered. We do have the option of using external funds where needed. And at this moment in time, every single one of the portfolio funds hold both internal and external funds. And we try to do this at low cost while still offering you that active management within there. Now, to sort of highlight this and the whole idea of staying with the process or investing with the process, I wanted to highlight the returns we've sort of seen this year, not just against the sector, but as a sort of one-off, sort of comparing it against the average sort of de facto fund, the average sort of volatility managed within that percentage, to sort of give you an idea how we perform, not just in returns, but in regards to that max drawdown, how far did these funds fall, and the level of standard deviation. And you can see pretty much across the board, bar the risk profile 7, higher risk, higher return. It does tend to sort of fluctuate, but we have managed to not only keep our level of drawdown lower than its peers, lower than the average, lower than its benchmark, but actually being able to return a decent level on top. Now, that's not by taking excessive risk, not by playing the market and saying we're going to heavily invest in areas we feel are good value and potential returns. We will always add diversification in there, even at the expense of potential short-term gains with the likes of government bonds. But what we do is keep that process aligned so that it doesn't match your client's level of risk. Now, there's the cumulative and discrete performance figures. I always show them because they're there, but I'll talk about that in a second. Costs for these funds are very well priced. We try to keep them. If you buy this unwrapped general investment or ISA, you can pick this up on a flat platform anywhere from 75 basis points up to 87. It is very, very well priced for an actively managed fund. If you buy within our products, because we're charging you a product fee, we do try to reduce the cost of the funds themselves. Now, I spoke about cumulative discrete. I've highlighted them. If anyone's sort of listened to me in the past, you'll know I've never been the biggest fan of cumulative or discrete performance figures, only because it's a fixed moment in time. If I jump back to the cumulative performance figures, and if you look at the risk profile 3, yes, we've outperformed the sector over a 5-year period, but unless you invested on the 31st of the 8th, 2015, you probably wouldn't have gotten those returns. Now, it's a good indicator for those sort of looking at the long-term growth. How does a fund manager perform against its sector over a 10, 15-year period? Are they better? Are they worse? What's the reasoning behind it? But what it doesn't show are those sort of blips in returns. You may have a top quartile fund over a 10-year period, could have had 8 great years and 2 abysmal years. Now, overall, it can end up being very, very good, but for clients investing at different times, and actually even for those in retirement who are actively taking out an income, you can have 8 great years, but if 2 of them are bad, it can really affect sustainability at retirement. So to sort of help combat this, we've been producing for a while now what we call our multi-period relative return success chart. I've been saying this for 5 years, and I've never once changed the title. It's extremely long-winded, and it's just full of figures. But all this is designed to do, once I sort of run through it, is to sort of give you confidence in the return. So sort of ignore everything that you see on the screen so far. These red boxes will pop up and show you exactly what this means. But this is an example of the Portfolio Fund 4. And all it's telling you is that if you'd invested into that fund in any month in the last 10 years, so not just the 31st of the 8th, 2010, it could have been 9 years, 11 months ago, it could have been 5 years, 3 months ago, any month in the last 10 years. And as long as your client stayed invested for 3 years, you connect the dots together. There was a 100% chance they would have outperformed the sector by an average of 5.4%. Now, it's not saying it's going to massively outperform, but it's consistency. It's like saying if you had 120 clients and every month for the last 10 years, you put one client into this fund every single month. As long as they stayed invested for 3 years, you should have a client base where 100% are outperforming. Again, consistency. And for those, especially at retirement, who are having to take out an income every single month, if the fund falls slightly less than the market, slightly higher than the market, you aim with that sustainability. Now, you can get a lot of support and due diligence across the board, whether looking for our funds, products, or anything else we speak about. It is all directly available online. More importantly, you will always have your account managers. If you do ever need anything, you will always have people available on the phone. When we're allowed on the road, you'll have people on the road as well. Now, just to sort of end it, you would notice with that one page I showed you performance figures, not only against the sector, but against their peers. It is very difficult to get like-for-like comparisons unless you manually go in and select all the funds and look at the returns. So we have been producing a comparison calculator to sort of help with this, and it just lists out all funds that have a risk profile within there, and it gives you a chance to view like for like. It'll give you the asset allocation. It'll even give you the sort of risk return charts as well. If you'd like a copy, do speak with your local account manager. They'll be more than happy to get a copy out for you. Now that is, I promise you, it from me today. I'm happy to take any questions anyone has. Please feel free, email them over, get in contact, or speak with your account manager. They'll be more than happy to help. But thank you very much for your time. I hope you enjoy the rest of the day.